Well, Marc Faber told investors in March of 2009, March 9th to be exact, when the S&P reached its lowest level since 1996 to buy stocks. Now, the S&P, as you know, rallied nearly 80% from that low. And then, at the beginning of March of this year, he predicted a 20% decrease in the S&P if the index reached a new high. Well, as you know, the S&P has tumbled more than 13% since reaching that high on April 23rd. Needless to say, he has been right on many major market calls. Joining us right now to talk about his latest call, and he laughs, Marc Faber, publisher of the Gloom, Boom, and Doom.
Not a bad run, Mark.
So,
no, because I've been also wrong on many market calls.
Well, that's fair, but you've been right on two big ones in the last couple of years.
Actually, it was March 6, 2009, when you called me. I was in Vancouver. That's why I remember you. So I think that maybe today we're in a similar position where the markets can rally a bit.
You think so?
Well, I mean, we've come hard down, and many stocks are down 25%. The Ukraine stock market is down 40%. The euro has collapsed. So we have near-term extremes. Sentiment on stocks is very negative because of Europe, because of North Korea, because of everything.
Right.
And nothing looks very good, but the market is a discounting mechanism, and we've come hard already, and we're oversold near-term. Not from a longer-term perspective. But secondly, there is a lot of support around 1,045 on the S&P, which was the February 5th low 2010, when we had made the high March 19th of this year, when the S&P had gone to 1,151, and then we dropped to 1,045. So around this level, 1,050, there's quite a lot of support.
Isn't there concern, though, still about the European banking system? I mean, whether or not Europe comes out correctly in their role as lender of last resort?
Listen, the banks are gone, but equally, interest rates are at zero, and the governments will print and support them. And don't overlook the fact that since the stock market began to decline after March 26th of this year from 1,200, what were we at the peak? 219. The bond market has rallied very strongly. We're up 10% on the long bond market. So interest rates on the 10-year Treasury that were close to 4%, they dropped now to below 3.20%. So that is essentially a positive also to look at.
Or, you know, I want to fast forward, Mark. I mean, if we look, let's say, in October of this year, what do you think we're going to be talking about? Is it similar things, more sovereign debt concerns? Will that be resolved by then, do you think, at this point? Will the nations have enough?
Don't worry, there'll be some new problems.
So in other words, Greece, Spain, and then who's next?
We had a very weak May.
Right.
And the market is near-term oversold. June, July is, from a seasonal point of view, usually better months. In other words, there is a summer rally.
Right.
I don't think we'll go and make a new high above 1219 on the S&P. I think that area around 1200, 1220 is a lot of resistance. But I think we can rally here somewhat.
And this is what you've been saying, really. You're sticking basically then to your forecast that we rally a little bit in June and July, and then October and November are difficult again.
Yeah, I think we'll go down and then probably bottom out sometimes in October, November, because at that time the next big stimulus package comes in and the next money printing. Don't forget, a strong bond market in the U.S. and a strong U.S. dollar gives the Fed more ammunition to ease again massively.
Right.
That shouldn't be forgotten.
Right. Marc Faber. So, Mark, you're hearing kind of positives, some negatives?
Well, don't misunderstand me. I'm very bearish about everything.
I was going to say, these are just trading calls, right?
Yes, it's a trading call. We can rebound here, and no matter how bad things are, or the worse they are, the more money will be printed and the more fiscal stimulus will come on. So stocks could go up and the economy can deteriorate.
Right. So, but you're bearish call long term. Nothing's changed.
I'm bearish about everything.
I'm not surprised.
On geopolitics, on the only
gloom, boom, and doom. He can't go any other way.
The good news is the weather is nice in New York.
And you know, before we went to break, we're talking about your views on the U.S. economy long term. I thought it was interesting in David Levy's note today. He's bearish because he says Washington seems to be gradually shifting its focus away from fiscal stimulus towards deficit reduction. It sounds like the kind of thing that would make you laugh, make you actually a little bit more bullish, but can it really be done to the extent that it makes you happy with the U.S. economy?
Well, we'll have to see and distinguish between what they say and what they will do. I think the fiscal deficits will stay very high, and actually I think they'll go up and not down.
And this is the reason that long-term you're very bearish on the U.S. economy.
Well, I think that the private sector is the dynamic part of the economy, and if you shift essentially away from the private sector and you tax the private sector and through regulation you make it very difficult for the private sector to know whether they should invest or not. Let's say if you have a corporation, there's so many new regulations that coming on, like healthcare and so forth, so you don't know how the future will look like. Are you going to hire and build new factories in America? I don't think so. So then the government takes the money away through taxation and gives it in transfer payments to people that are on the beach. Okay, doesn't disturb me because I'm not an American citizen, I don't work here. But if I was a working American and or a corporation that, or an executive that runs his business, and the money is taken away from me and given to people that actually don't work and are not productive,
right,
that is not a very happy state of the economy.
You know, Mark, Matt mentioned David Levy. He's going to be a guest on later. And he also says the chances of a double-dip recession have increased greatly for later this year. You think that is...
60% now.
I'm not so sure there was ever really a recovery, because if you look at federal tax receipts in April, they're still down vis-a-vis a year ago. And March, April 2009 were kind of the low point of the economy.
Right.
You look at the stock of Walmart, it's no higher than it was a year ago. So Walmart is maybe telling you more about retail sales than government statistics that are all doctored and massaged.
But we had growth in GDP. If we carry it through this quarter, it'll be a full year of GDP growth.
Growth in GDP is very difficult to measure, because depending what you calculate as your personal consumption expenditure deflator, you get different figures. I don't think that GDP has increased. So I think it's about flat. And certainly it's lower than it was in 2007.
So do you expect what other people would call a double-dip recession? You think it's just a giant U here?
I think that the economy will settle down at the lower level of, let's say, equilibrium than what we had prior to the crisis.
So in other words, the new norm going forward, it's a different type of growth, correct? Because the growth that we had way back when was not
in my opinion. Now, you understand, when you have huge fiscal and monetary stimulus, and at the same time you have private sector credit contraction, you can get huge volatility in economic and financial activity. So for 3 to 6 months the economy may look good, and then suddenly it looks bad, and you move from inflationary expectations, as we had in 2009 when people sold off government bonds and they bought equities and commodities, and now in the last 3 months you have a strong dollar, and you have again a strong bond market and weak asset prices. So we've moved back into a more deflationary expectation environment.
Well, one asset that we've been watching very closely is what's been going on with gold, because even with all this increased market volatility, certainly on the equity side, you're seeing gold prices also move down. It's kind of an interesting move. Is everyone just afraid to hold any type of asset class, and should they be afraid?
Well, I mean, gold has moved down from the peak, but it still performed very well over the last 18 months or since the beginning of the year and so forth. And, I mean, we just have corrections once in a while. Now, I believe that it is conceivable that gold goes down somewhat more. But in general, when I look at all the asset classes in the world, and I look at the forthcoming disaster that I envision in the next few years, then I'm quite happy to hold physical gold.
What else? Other sovereign debt, Canadian, Norwegian?
Well, I think that in Asia we have equities that are not terribly expensive. You could buy now a basket of Singapore shares or Thai shares with a dividend yield of 5 to 7%. I mean, I don't think they'll go up right away, but at least you get a 5% dividend yield every year, so you're kind of paid to wait. Same in Hong Kong.
I wonder what you think governments should do. You know, the typical response now to a fiscal crisis...
They should all resign. Go away on a holiday.
Well, I don't know that that would help much more either, would it?
I think it would, actually.
Total anarchy?
Well, anarchy does not necessarily mean a bad anarchy. You could have a free market where people would understand each other, and rather than hit each other's head, they would trade with each other and do business with each other without too much regulation.
Right.
I don't know. I believe government should be there because they have to say you should drive your car on the right-hand side or left-hand side of the street, and I think they should have a police force, and I think they should do foreign policy. But beyond that, they should stay out of the economy, and this is something Mr. Obama and these clowns around him don't understand. They think they have to intervene in every sector of the economy. They're going to destroy the economy.
All right. And I actually want to ask that to Marc Faber. I mean, do you think we're going to have a sequel?
Credit Crisis 2?
Credit Crisis Part 2?
Yeah, I think eventually the sovereigns will default, or a lot of sovereigns will default. It's just a question of when. I think in the US they can print money easily, so it can be postponed for an extended period of time. But eventually it will happen.
Better if we just let them default now.
Well, certainly in the case of Greece, they should have let it default. I think it would have been a better solution. In the same way, I think it would have been a better solution to let AIG go.
Right.
But it eases the pain, you could argue, if they buy themselves time and then they restructure the debt in a calmer way.
I agree with you. Listen, I've been drunk so many times in my life. The best way to postpone a hangover is to keep on drinking. And so you just drink and drink and drink, and eventually you collapse.
So in the long term, we're all dead, is what you're saying.
In the long term, as I always said, we're all doomed. But in the meantime, because of the volatility in the markets, you can make money. The key will be to know, and that is, as Goethe says, genius is to know when to stop. And when you stop, how to allocate and where to allocate your assets.
Well, so let me ask you, because you've been so right on many significant calls here in the last couple of years. So in terms of the big volatility swings to the upside, I mean, how big could those moves be? And what will tell you that that's coming?
Well, I think they could be huge. I mean, really, we have had a lot of...
20%, 30%, what?
Well, I mean, as I said, on the stock market from here, I don't think that we will exceed the April 26 high right away.
Right.
We could have a rally and then again a correction period, and then eventually when more money printing comes in, because really what the Eurozone has done by monetizing, they've given another opportunity to the Fed to monetize as well, because the dollar has been strong. And so it's a race in the purchasing power of paper money to the bottom. And the only assets that will for sure keep the purchasing power are precious metals.
All right, precious metals, you heard it, Marc Faber.